Mortgage demand has hit a 25-year low and is down 4% week over week and 38% year over year. Demand is down for two reasons. Number one, interest rates are pushing some buyers out of the market due to affordability, and it's also pushing out a lot of potential refinances because of the higher interest rates that we're seeing right now. Rates are now back in line with what we have seen historically dating back to the pre-2000s year. Take a look at this chart. We're just looking at rates that we have seen really for most of the history of this country. But what we've seen over the last couple of decades is historically low interest rates. So the question is, are we going back to normalcy with interest rates, or are we going to see a refinancing boom over the next couple of years? And I personally think we'll see that refinancing boom. And the reason for that is take a look at this next chart. Look at the GDP chart. That is a exponential growth over the last decade and really the last several years. And with that record increase in debt, the Fed is the largest borrower of this debt. And so basically the interest rates that they are charging themselves are unsustainable at that debt levels. And most economists are predicting that they will have to decrease those interest rates over the next year, maybe year and a half or 2 years. But at some point in the near future, those rates are going to have to come back down. So here's our recommendations during this low demand and high interest rates or higher interest rate market that we're in right now. One thing that we're not recommending, and a lot of people are looking at doing right now, is we do not recommend buying down your interest rate. And the reason for that is going back to that GDP graph. With that, we expect that interest rates will start to come back down definitely, or in my opinion, definitely within the next 1 to 2 years. And so for that reason, you wouldn't want to buy down a rate just to refinance in another year or two. If you think we're going back to historical interest rates and interest rates are going to stay high for the next decade, that's when you would want to buy down the rate. So what we are recommending with our predictions is a couple of things. Number one is we're recommending looking at adjustable rate mortgages. Go ahead and look at, with adjustable rate mortgage, go ahead and look at getting that lower interest rate today versus a 30-year fix, since you're not likely to need that 30-year fixed rate for that 30 years. Due to a potential refinance scenario. So if you believe interest rates will come down over the next 1 to 2 years and you're able to take on that risk, ARMs are a great option to consider. The other option to consider is during a period of more motivated sellers, asking for the seller, and particularly if you are a seller offering this as a negotiation, a 2-1 rate buy down. A 2-1 rate buy down lowers the interest rate from what the current rate is down to 2% less the first year and then 1% less the second year. So for example, if today's rates were 7%, the first year rate would be 5%, the second year rate would be 6%, and then when it resets to 7% in the year 3, you would likely, based on most predictions, be looking at already refinancing that home. And so with those recommendations, we're making the recommendation to marry the home, date the rate. So marry the home, date the rate by a 2-1 rate buy down or an ARM product, and then look to refinance over the next couple of years.